So the outlook for China has clearly improved, and we've upgraded our forecast quite significantly in recent weeks. So we now think that China's economy will grow by around 6.2% this year. So that puts us at the upper end of the consensus. The reasons for that are that zero COVID policy has got away far more quickly than anyone thought was possible. Exit wave of cases has happened far more quickly than anyone thought was possible. And we're seeing mobility, some of those high frequency indicators come back pretty strongly. PMIs are also good this week and better than expected. So it does seem like China's economy is coming back, and we think growth will be pretty strong for the next few quarters before tailing off into next year. In terms of the global impact, faster growth in China mechanistically lifts global growth. So if we add 1 percentage point to Chinese growth, we add 0.2, 0.3% to global growth, just because China is so big. But China runs huge external surpluses, so it's not a big source of aggregate demand for the rest of the world. And this time we think that the recovery is driven by services, not through housing and construction. So the spillover is actually quite limited to the rest of the world. The return of tourists to sort of Asian holiday destinations is clearly positive for those economies. The manufacturing cycle, we don't think that will be as fruitful for regions such as Europe, which have historically exported capital goods to China. But on the commodities side, rather than a metals-intensive recovery, a services-driven recovery to us should be more fueled by energy and oil. So actually there is a risk, it's not a kind of baseline assumption, but there is a risk that actually strong recovery in China drives up oil prices and causes inflation to come back in next year, reducing the amount of room for central banks to lower rates again.
Right. I want to take things stateside, and we've been talking about whether we're going to see 25 basis points or 50 basis points at the next meeting. And between now and the next meeting, we still have the payrolls report and the CPI figures. Do you need to see both those data points before you can have a rough sense in terms of where the Fed might go?
Well, there's always a risk, but I don't think the Fed is going to overreact to just one data point. I think probably policymakers think they've done the majority of the tightening that they need to do to eventually cool the economy. Clearly, at the moment, the US economy is still robust. The labor market is still quite strong. And so in that environment, probably the Fed needs to raise rates further. But as I said, we think most of the tightening is done. So we think they'll continue to move in 25 basis point steps, unless the data is shockingly strong. And we think they will do that 2 more times into the second quarter. And actually, they might start to cut rates before the end of the year, because although the economy is holding up well and frankly a bit better than we assumed it would do, there are still areas of the economy that are kind of flashing recession to us, and ultimately higher rates will come through with those longer variable legs that policymakers talk about, and growth will slow. We think there'll be still a mild recession later this year.
On that note, then, on a balance of risks, which is more concerning? Is it the risk of persistent increasing inflation, or is it the risk of the rate hikes eventually, killing the economy, lack of a better description?
So I think you've got to split it up into two sections. So clearly at the moment, the focus is on whether or not the economy is going to cool down, because it looks pretty hot at the moment in the services side and the labour market. So near term, I think the risks are actually skewed on the upside. And as I said, there's a risk that China reopening pushes up energy prices and leaves less room for inflation to come down. So short term, there's a risk that rates go up higher. But as I said, we do think the economy in the US will go into recession later this year, and that rates will then eventually come down. So, the baseline forecast is that the Fed tops out at 5.25. There's a clear risk they could go higher. But of course, the further that rates go up in the near term, the nastier the correction in the economy would be further down the line.
By contrast, how do sort of the challenges that the US Fed is trying to deal with differ from perhaps the ECB or even, the UK?
So I guess in Europe, there's a bit of a reprieve from the energy crisis. So the last year, it's been all about energy crisis, high inflation and the damage that that's done to the economy. At the moment, there seems to be somewhat of a respite from that energy crisis. So European gas prices have come down. That's helped inflation to come down, and it's allowed activity to pick up. And so I think if we're moving out of crisis mode, the ECB can focus more on the fundamentals of it also has a tight labour market and a relatively high core inflation. And so focusing more on that at the moment, rates go a bit higher. Now, we assume that rates will go up another 50 basis points at the next meeting, and that actually that might be sufficient. Policymakers might think that's sufficient. But again, at the moment, the risks are tilted to the upside. In the UK economy looks pretty poor, to be honest. So we became less pessimistic on, say, the US and Europe in the short term. But on the UK, we're still pretty pessimistic because we've got problems in the labour market, shortages of workers. We've got barely any growth, if any. We've got supply chain problems. And we've got a government that's delivering austerity and interest rates have risen. So our call, and it's a non-consensus call, but our call is that actually the Bank of England might have finished raising rates. And Andrew Bailey sort of hinted at that this week. And the reason for that is that even if inflation is still quite high, they're worried about the housing market. And house prices are starting to come off now, and they might go off quite aggressively.